Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. We've named this monthly update Diversifying While Delivering Alpha for many reasons, which Andrew will go over and then some during his commentary. But beyond performance, as we approach the 5-year anniversary since DBMF launched, we really hope our investors and prospective investors can feel the genuine enthusiasm we have for what we're looking to accomplish, and that is to deliver a truly diversifying, low-cost, alpha-generating, elegant solution for portfolios that make your job as allocators and advisors better and a little bit easier, and ultimately, the most important part, better for clients and shareholders. We really do believe that DBMF is distinctive. And that's my elevator pitch open today, Andrew. So with that, please begin.
Thank you, Mike. And as always, thanks to everyone for listening in. So, wow, what a month. DBMF rose 4.4% net on a price basis, while the S&P 500 dropped 4.1%, and the Bloomberg US Aggregate Bond Index declined 2.5%. Year-to-date, DBMF is up 16.8% net on a price basis, several hundred basis points ahead of the SocGen CTA index, here and after the hedge fund index, and over 680 basis points ahead of the Morningstar US Trend Systematic category, here and after the Morningstar category. On the macro front, inflation fears are back and macro strategies are whispering that dreaded word, stagflation. The hope for Fed cuts are not coming anytime soon, and a few economists have started to talk about a potential rate hike later this year. For allocators, a serious problem is that stocks and bonds are moving in tandem, again, after a brief respite earlier this year. And just as a reminder, as many market researchers have talked about recently, when inflation is above 2.5%, stock and bond correlations tend to be positive, which is contributing to what we think is a grinding shift from 60-40 to 50-30-20. As you'll know from last month's report, CTA's dialed up equity exposure in the first quarter, and this was a big contributor to gains through March. As we'll explain shortly, we did give back gains on equities this month, but those losses were more than offset by gains in inflation-sensitive trades, rising commodity prices, the king dollar trade as the Fed keeps rates high while weaker economies cut rates, and a bet on rising rates through short positions in treasuries. Now let's get a bit into the weeds. Next slide, please. So here's a variant of our regular chart on stocks, bonds, and DBMF, except with a smaller time frame to show just the performance year to date. As you can see, during the first quarter, as equities rose strongly, DBMF rose as well, benefiting not just from the pivot into long equity exposure, but also from some gains in other asset classes. Naturally, periods like this do fuel fears that a reversal in equities will necessarily hurt trend followers, that the diversification benefits of the strategy have somehow been eroded. As you can see, this is not always the case. While both equities and bonds both rolled over in April, DBMF continued to march upward. The reason, of course, is that managed futures funds invest across all four major asset classes, not just equities, but also rates, currencies, and commodities, and they can benefit from price moves either up or down. Hence, this flexibility and diversification means that there could be plenty of opportunities, even during a difficult month like April, as we'll show in more detail in a few slides. So for me, last month was a case study in this whole idea. Next slide, please. Now here is our regular chart on stocks, bonds, and DBMF. Since inception, DBMF has returned 10.2% on a price basis per annum, with a negative correlation to both stocks and bonds and over 1,000 basis points of annualized alpha to equities. On May 9th, as Mike mentioned, we hit a huge milestone. DBMF celebrates its 5th anniversary since launch. Back then, we set out to prove that we could build an ETF that could outperform leading managed futures hedge funds, but with a fraction of the fees and full position level transparency. Today, the fund is above $1 billion in AUMs, and our hope is that DBMF will become the default allocation for model portfolio allocators in the wealth management space as more and more firms embrace the diversification benefits of trend following. Over the coming months, you'll hear me talking a lot about how and why we think managed futures becomes the next asset class to really go mainstream, similar to what happened to private equity, REITs, private credit, etc. Oh, so at least that's the dream that gets Team DBI out of bed in the morning. Next slide, please. Here's our slide on volatility adjusted positioning. Now, the portfolio has been dynamic all year. As the target hedge funds readjust their positioning, we follow along. Rather than show current positioning relative to year-end, as we did last month, we're showing it here relative to just a month ago. We're doing this to underscore that we've seen some de-risking this month. The most important, of course, has been taking profits in long equity positions. So one of the things I really like about the strategy is that quant models are very dispassionate about exiting positions when they stop working. In a sense, it reminds me of a good trader who takes gains and thinks quickly about how to redeploy the winnings into other opportunities. Having watched the portfolio really push the long equity trade earlier this year, it's something of a relief to see some de-risking given what feels like a much shakier market than a month or two ago. So you can also see some risk reduction elsewhere, like the longs in gold and oil, but the big action really was on the equity front. Note that as of today, our positioning is relatively balanced, with some positions that might stand to benefit if inflation fears recede, e.g. equities, while others that might benefit if the US inflation genie gets closer to escaping the bottle. Long crude oil and gold, long the dollar against the yen, and modest shorts in treasuries. Which brings us to the next slide. Here is contribution by factor. So I was trying to think through how to describe this idea of handing the baton from equities to other asset classes in April. So the best I could come up with is side-by-side comparison of year-to-date gains through March, then compared with year-to-date gains and losses through April. In April. This seemed a bit easier to visualize than showing lots of bars with monthly figures. So the left bars are what you saw in last month's performance slides. A good percentage of gains through March were indeed from equities. Initially, the S&P 500, then more so from EFA, or non-US developed markets later in the quarter. As noted, the yen was in fact our single largest gainer, and we were starting to see some gains pick up in other areas. Then in April, you can see that we gave back gains on those equity positions, but you can see sharp gains in other positions. More gains on the yen, but also in gold and treasuries. And with that, I'll pass the baton back to Mike.
Thanks, Andrew. So let's wrap here as we usually do with our long-term performance comps. And with this really strong April that we had, DBMF has expanded its outperformance against its two key benchmarks, now ahead of the SocGen CTA index by 240 basis points annualized, and ahead of the Morningstar systematic trend average by over 440 basis points annualized. And of course, our expenses, which are less than half of that of our Morningstar peer group, is just another compelling differentiating factor for DBMF. So since I led this call with plenty of verbosity in the opening, I'll keep it to a minimum here at the close just to say thanks as always to our clients and to our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.